Let's face it, trading is not a team sport, and it's not a collaborative process. There are no committees, and there is no one to blame for your failures. There is no one to take credit for your successes. It's just you and the chart. High-level professional athletes spend tons of time and dollars with sports psychologists trying to understand the nuances of their mind and how it affects their performance in their given field. Now, you're just starting on your journey to be a trader. You probably don't have the time or dollars to invest in a professional performance psychologist. However, that does not negate your need to understand how you think on a daily basis and how your current and past experiences may affect your decision making in the future. Now, I've been through tons of books and courses on trading, and not one even mentions this critical aspect. I've got one more small basic section on placing orders, and then we'll start to take a look at your age and your life experience level, what you are doing now, what you've done in the past, and how those things may affect your trading decisions. You need to be aware of how you think before you start trading, or you run the risk of losing hard-earned money. Let's discuss some order types. The term order refers to how you will enter and exit a trade. Here we discuss the different types of orders that can be placed into the market. Be sure that you know which types of orders your broker accepts. Now, there are two ways you will most likely place your orders. The first is with a broker, and the second is online yourself via some type of order platform. Now, a full-service broker is someone that you can actually talk with. You would call him or her and place your orders over the phone. If you place your order through a broker directly, you'll be paying a full-service brokerage fee. Now, that's normally between $30 to $60 a turn, with all exchange fees included in that price. Turn is used to describe when you open and close a position, when you buy and then sell, or sell and then buy a contract, versus a side, which is one half of a turn. To open or to close a position, you're either buying or selling a contract. There are also discount brokers. For a discounted commission, they will place or allow you to place directly via a trading platform your order. Commission rates can be as low as $1 plus exchange fees depending on volume of trades you make. Now, don't get suckered into placing more trades to get a lower commission rate. You'll end up losing more money by overtrading your account. Find a broker that will allow you to place your orders for a reasonable rate. Something under $10 a turn plus exchange fees is reasonable, in my opinion. You should be able to find a broker that will let you place orders for $5 a turn. You may be able to talk to a discount broker, but remember, discount commissions means discounted service. If you feel the need for someone to personally walk you through things, you'll pay for that additional service. Most traders are using a discount broker and hardly ever speak with them. If you place your order via the broker's sales desk, you may not pay a full-service brokerage commission, but you'll need to check with your broker and the company that he represents. If you're using a discount broker, there may be an additional charge from the sales desk. Correct placement of an order saves time and assures that you are doing what you intended to do. When you place an order with a broker or at a sales desk, the brokers will repeat the orders back, and if need be, may engage in a conversation to explain the impact of that particular order and its effects on your account. For those that choose a discount broker, they should have a firm understanding of the different order types and be comfortable with their use. Proper order placement can help you get the fastest and best possible fill, which is the price you actually pay. It is the proper placement of an order that will help you get your order to the pit as soon as possible. I prefer trading the electronic markets. Many fewer surprises with bad fills. Now, here's a list of some of the most common order types. After a brief description of the order, an example will follow as to how you would use that particular order. Keep in mind that the orders are used in the same way if you go long or short. You would just tailor the order to suit your current position. All orders will be considered day orders and will expire the day you place it unless you specify that you want it to be a good till canceled order. Let's go over the most common types of orders you'll use. The first is a market order. This is the most common and worst order to place. This order is used when you want to get the order executed immediately at the market price. This order is used to enter a new position or to exit an existing position. This is generally used when you're chasing a market to get in and you're desperate to get out. If you end up using this type of order, something went wrong, or you're not following your plan and things are out of control. Example. My account number is 12345 and I want to buy 1 May corn at the market. Now, this would enable you to go long at the market. You could obviously use this order to sell one May corn at the market and also go short. The second is a limit order. This order is placed when you're looking to enter a new position or to exit an open position at a specific price or better. For example, if a person wants to buy one May corn and the current price is $275 per bushel, and they are not willing to buy it higher than $275 per bushel, which may happen if you use a market order, because while the order is being placed at the market, it could trade higher by the time your order hits the pit. This would have you place an order to buy one May corn at the 275 limit. This tells the brokers in the pit that you are looking to purchase the corn at no higher than $275. The market may trade at $275 several times, and you still may not get filled at your price. The reason is that in a limit order, you are only guaranteed to be executed if the market trades through the limit price. If the low of the day is $275 per bushel, it is possible you were executed at that price, but more times than not, your broker will report to you that the trade was unable. If you are in a position either long or short and are looking to exit a trade at a particular price, you could also use a limit order. For example, if you are long May corn at $275 per bushel and want to take a profit at $290 per bushel, you could place your order to sell one May corn at $290 limit. If you are short one May corn at $275 and want to take your profit when it drops to $265 per bushel, you would place the order to buy one May corn at $265 limit. Once again, if the market just touches your limit price, even 20 times, and does not penetrate it, you are not guaranteed a fill and should not be surprised when your broker advises you that you are not filled. Now keep in mind that any order that you decide to place is taken as a day order. The order is canceled at the close of the market on the day you placed your order, unless you specify that you want the order to be working until you cancel it. This is a GTC, or good till canceled order, which will be covered later. Now the third is a stop order. This order becomes a market order only when the specified price level is reached. This order is used to either enter a new trade or to exit an open trade. The stop order does not guarantee that you're going to get in or out at that exact price because, as stated, when the price is reached or penetrated, the order becomes a market order. A buy stop is placed above the market and a sell stop is placed below the market. Stop orders are commonly used to enter a market when the market is moving in that direction to protect profits or attempt to limit losses. Now keep in mind, while trying to limit losses, a stop order may not limit your loss to the amount intended. A stop order is considered a day order unless you specify that you want the order to be a GTC, or again, good till canceled order. Now here's an example. To enter a new position with a stop order, you call your broker and ask him where a May corn is trading. Your broker tells you it's at $275 per bushel. You are interested in buying a contract, but you don't want to buy it until the market shows you some strength by getting up to $285. This would require you to place your order to buy one May corn at $285 on a stop. Now this order tells the people in the pit that you're only interested in buying one May corn if and only if the market goes up to that price and not before. When the market trades at $285, the order becomes a market order and you will get the next best price. If the market is trading at 284.5 and the next trade is 286.25, you may fill at or around 286.25 and not the $285 that you have in the order. Remember, on a stop order, you are filled at the market price once it is traded at or through the specified price. Now, the second way to use a stop order is to protect profits. An example would be you call your broker because you are long one contract of May corn at $250 per bushel. Your broker tells you that the current price is $285 a bushel. You're obviously excited at your $1,750 profit. This profit is unrealized because you haven't sold it yet. And you want to protect some of it in the event that the market reverses and you lose all of your hard-earned money. So you decide to place the stop order at $275 a bushel. By doing so, you would tell your broker that you want to sell one May corn at a $275 stop. This means that if the market started reversing and got to $270, your stop loss would become a market order and you would be out at or near the $270 price. Therefore, you have locked in a profit of roughly 20 cents or $1,000 and can chalk up that to a good trade. Now, the above is an example and does not take into effect the obvious cost of commissions and fees. You should plan on deducting these costs from your profit to get the net profit. Now, the third way to use a stop loss order is attempting to limit losses. Here's an example. You call your broker because you are long one contract of May corn at $250 per bushel. Your broker tells you that the current price is $245 per bushel. You are not happy because you realize you are down 5 cents or $250 on the trade. You're not wanting to risk more than $500 on the trade, so you decide to place a stop loss order with your broker. You advise them to sell one May corn at $240 on a stop. Again, this does not guarantee you can't lose more than $500 because, as stated before, when the market trades at or through $240 per bushel, the stop loss order becomes a market order, and you are filled at the best price the floor broker can get for you. This may be $240. This may be $240, but don't be disappointed if your broker gives you $239.50 or worse. Now, another market order type is called MIT, or market if touched. This order is similar to a stop order in that it is executed only if the price reaches a specified level. Now, like a stop order, when the market trades at or through the price, your order becomes a market order. Now, the fourth common order type is a GTC order, or a good till canceled order. These orders are also known as open orders. This type of order is always working on the floor of the exchange unless it is executed, canceled by the client, or replaced by another order. When you place an order with a broker, it is assumed a day order and will expire at the close of that market's trading day. If you wish to have an order working beyond the day you placed it, you must specify a good till canceled order. Every protective stop order should be placed as a GTC order to protect your account. Because GTC orders don't expire on their own, you need to keep track of these orders and remember to cancel them when you no longer want to place that specific order. Now, the next order type is called an OCO, or order cancels order. An OCO order is a stop and limit order set simultaneously, whereby when either one of them is executed, the other is canceled. For example, an OCO may be placed to close an existing position either with a limit, take profit, or with a protective stop loss. This order is also used to enter a position by bracketing a price channel going long on a breakout to the upside or short with a breakout to the downside. Now, different trading platforms will have different mechanics involved with placing orders through their systems. You need to understand how to place orders in the system you are using. This is part of learning a new set of job skills that will allow you to break free from whatever may be happening in your W-2 type job in the economy in general. Use the trade simulator function of whatever software you are using. Trade a simulated account so you can actually place orders to both open and close your positions. Do this for a few weeks to several months to ensure that you are more familiar with the software, trading platform, and trading your system. Placing your order properly will enable you to save time and reduce the possibility of making an error, which will cost you money. So to summarize, the basic order types, market, stop, limit, good till canceled, and one closes the other, are usually all the most traders ever need. Unless you are a veteran trader, don't get fancy and design a system requiring a large number of orders sandwiched at the market at all times. The more orders you have open, the more things that can go wrong. Stick with the basics. And make sure you fully understand or are comfortable with your broker's order entry systems before exiting a trade. And lastly, and most importantly, do not make a trade with real money until you have an extremely high comfort level with the trading platform and your order entry system. Now next, let's talk about your TTA, which is your trading type, your temperament, and your account size. Now, how do you know what they are? Or who cares, right? You only want to make money. But before you go any further, you need to give your TTA some thought. If you don't, just stop now and throw all your money into the first crowd of people that you see. I could show you how to become a great day trader, but you have a W-2 job that uses all your time during market hours. I can show you how to trade the Dow, but the margin for one contract is $16,250, and you only have $7,000 in your account. And I could show you how to long-term trend trade, but you don't want to sit in a position for 6 months. So you need to identify what trading type is going to fit your specific situation. Do you have free time during the day, or do you work during market hours? How much time can you put in with studying the charts? If you have 1 hour a day, you'll have to trade differently than someone that has 4 hours a day of clear time. And how is your risk tolerance and temperament? Can you sleep at night having $2,500 of open profit at risk, or would you rather get $50 win and call it a day? Do you thrive on action, or are you comfortable and possibly even preferring to just trade once a month? How much money can you put in your trading account? Is it really risk capital, which is money that you don't need to pay the bills? Do you have $100,000 or only $5,000? The amount you have affects what you can and should trade. Let's look at the main types of trading in relationship to TTA. First, there's trend trading. A trend trader, sometimes called a position trader, likes to follow the overall trend up or down for an extended period of time, regardless of the corrections that may take place until the trend is exhausted. This is the slowest type of trading. The end-of-day trend trader may wait 2 to 4 months before conditions are right to put a trade on. The trend trader may hold that position open for 6 to 9 months, almost like a short-term investor. Holding a position that long exposes the trend trader to more market risk. However, the trend trader spends just a few minutes a day checking their position. Because end-of-day trend trading is slower, the trend trader has the opportunity to socialize more than most traders. Now, depending on the market's trade, a $5,000 account would be adequate starting capital trading one contract with good money and trade management. Now, the second is swing trading. The swing trader, sometimes called a counter trend trader because they'll trade both ways, looks to capitalize on short-term trends. End-of-day swing traders can be in a position from a day to 2 weeks generally. They may spend 10 to 15 minutes per chart on a daily basis reviewing current and pending possible positions. This is a faster pace than trend trading. An end-of-day swing trader can put on as many as 30 trades a month or as few as 2 depending on their trading plan and account size. Putting on more trades exposes them to more market risk. They are making more trading decisions in a week than an end-of-day trend trader will make in a month. This gives them the chance to gain experience that much faster. If they make the wrong decisions and don't follow their trading plan, they also have the opportunity to wipe out their account that much faster too. If they only trade one contract at a time, a $5,000 account will work for them with good money and trade management. Because they are a bit more involved on a daily basis, their time to socialize would be a little less than that of a trend trader. Then there's the day trader. The day trader never holds a position overnight. Whatever trades they put on during the day or trading session, this may be at night, they close by the end of the session. They are always flat when they finish the session. Now, day traders can be trend or swing traders, but use these methods on a daily basis, closing all their positions by the end of the day. Trading this way may have 1 to 5 trades per session. They trade a shorter time frame, a 4-hour, an hour, 30-minute, 15-minute, 5-minute, to a 1-minute chart. But you don't need to trade the entire session. Some day traders only trade 2 to 3 hours a day and then call it quits for the day. When you get to day trade and you do it properly, it's almost boring. You just sit there and wait for the right conditions to occur. The margin for day trading can be as little as half of what would be required for an end-of-day position. Day traders seldom leave their screens while they have an open position. If you're a day trader, it's just you and your screen while you're trading. There can be no distractions while you're trading. You need 100% concentration on what you're doing. Day traders are also referred to as scalpers. Scalpers could be in and out of the market as many as 50 times or more during the day. They try to capture several tick movements in the market. $5 here, $10 there. It just seems like a lot of work and not the most lucrative either. This is the most intensive type of day trading. It was the primary activity of floor brokers when the majority of commodity trades were executed on the floor of the exchanges in groups of traders trading the same commodity in areas called the pit. I don't know of anyone making a living scalping other than the broker picking up all those commissions. And then there's my favorite, the end-of-day scalper. It is possible to be an end-of-day scalper. By trading in this fashion, a trader would take a position with a very short-term target that usually achieved in 1 to 3 days. End-of-day scalpers should have a high percentage of winning trades, over 70%. The winning trades generally have an average $200 to $600 gain per trade. End-of-day scalping methods that have too small of a target, generally under 5 to 8 ticks, have their profits chewed up with commissions and exchange fees. Candle signals are useful here because of their short-term nature, and this can be done with a small account. The margin requirements are the same as swing and a position trader and vary per contract and broker. The time requirements remain close to the same as a swing trader, so this does not tie you to your computer or your charts all night. Let's talk about account margin. Account margin requirements will vary, but most brokers want at least $5,000 to open a futures trading account. I mention this only for the sake of completeness. We don't want you to think that we're holding information from you, but you can probably open a Forex account with as little as $500. We've already mentioned that 90% of traders lose money in the markets. Our guess is that 95% of retail traders, people like us, lose money in the Forex markets. There are serious major banks playing that arena and have the best and the brightest traders, as well as computer programmers and analysts working for them. The Forex markets are basically unregulated. There is a bid-ask spread system. That means that your fills are considerably worse than in the regulated electronic futures markets. Play here only after you've had several years of profitable experience in the futures markets. By that time, you'll have sufficient background to make an informed decision for yourself. Now back to day traders. This is where most professional traders, people that make their living, and generally a very good one, are, and where a majority of retail traders would like to be. Most day traders that consistently make money didn't get there by taking a weekend seminar or a 2-week course. Most day traders have years of experience in several markets over different economic conditions. So please don't get frustrated and think that you can do this overnight. However, if that's your goal and you put in the time and effort, you will get there, just not in the next few weeks. Now, where do you think you fit in, and where should you start? We've already mentioned that generally you'll need a minimum of $5,000 to open an account. If you trade only one contract for a while and you are careful with your trade and money management, that should be okay. But you'll have to be a conservative, disciplined trader, only taking the best trades. If you have more money available, that's good. But I don't recommend that you put more than $20,000 into a starting account. This will give you plenty of breathing room and take some pressure off while you gain experience. For trading type, I recommend end-of-day scalping, short-term trend, and/or a swing trading strategy. This will get you a sufficient number of trading opportunities without keeping you from the rest of your life. And as you gain more experience and more money in your account from trading, your temperament will change too. That's generally a good thing. Now, temperament, that's all you. In the next section, I'll go over the trader's mind and see what you think. The trader's mind. When we talk about trading and charts, our only concern is what price is actually doing and how we are going to react to that price move. Other than understanding why the markets move, this is the only other area that you actually need to know, and more importantly, understand the why. Now, I can give 10 people a system that we've tested with a 65% win-loss ratio with an average $1,000 winning trade to an average $200 losing trade, and each person would have different results. Some would even show losses. But how can that be if the system is actually any good? Maybe the testing was off, or even worse, made up. Our first reaction is to question the system. Maybe it was all hype, a marketing ploy, or some type of Madoff Ponzi scheme. But no, the system actually does what it says it does. If properly run, it could make you a lot of money. So what's the problem? It's a people problem. The system is just fine. It's the people that operate the system that have the problem. Why do you think that McDonald's needs to have a printed warning on their coffee cups advising that the contents are hot so some person doesn't put the cup between their legs and get burned? Is the coffee bad? Why do you think that every hairdryer has such a large tag on the plug advising not to use it in water or you might electrocute yourself? Does the hairdryer not work properly? Why do you think that every time you see or touch anything that deals with futures and Forex that there's a big disclosure in the first few pages or the first few seconds of the recording? Do the markets not work? Is everyone losing money? One of my favorite authors, Jack Swagger, has written well over a dozen books about trading. In his books, Market Wizards, which is a national bestseller, and The New Market Wizards, he interviews dozens of top traders. The overriding consistent message from all of them is not how good their system is. It's not how they have the best computer or the best indicators. It's not how they were just lucky or born into being a great trader and making tons of money. It is about the belief in their system, the consistency and discipline to follow their rules, and their money management and position sizing. Let's look at a cross-section of the population in relation to their income. What do you find when you look at this chart? I've added a third column titled Bell Curve on the right and the information contained there. As you can see, the majority of people fall into the median and then drop off almost equally as you move to the next three areas. The numbers differ considerably on the extreme area 4 steps away from the median. Why do you think things break down this way? We contend that the vast majority of people in the median and areas -1, -2, -3, and +1, +2, and +3 are employees. There is a certain, although often dislike, of the comfort in knowing that I can go to work, do my job, whatever it may be, leave and get a predetermined amount of money and not have to worry about anything else other than my own personal situation. Now, this is not good or bad, right or wrong, it just is. The people in area -4 have generally fallen on hard times and don't have the education or job skills to move beyond that area. It's some of the people in area +3 and the people in area +4 that are different. It's not that they're black, white, Hispanic, Middle Eastern, or Asian. They may be. It's not that they're male or female. Obviously, they are one or the other. And it's not that they're Jewish, Catholic, Mormon, or Muslim, although some may be. I believe that the majority in this group are the working professionals. Doctors, lawyers, accountants, financial planners, professional salespeople, business owners, professional athletes, and entertainment folks in movies, TV, and radio. This group of people tend to be better educated and somewhat more aggressive in their approach to life, thus the higher income. Again, this is not good or bad, right or wrong, it just is. Now, where are traders in this grouping? Remember we talked about the players? The professional, institutional, and commercial traders are in area +4 and beyond. The small specs are in areas -2 to +4. Why is there such a large divergence in incomes of the small specs, which are us? Now, experience has shown you can parse up the bits and pieces of why someone is as they are and act as they do, but in the end it comes down to two very basic things. An individual is the sum total of what they have read and the experiences they've had. So we need to look at our own experiences and what we read. If we change what we read and get some directed experience or learning, we should be able to change our income level. But first, is a trader's mind different from other people's minds? Let's look at the brain. The reticular formation is a part of the brain that is involved in actions such as your waking sleep cycle and filtering incoming stimuli to discriminate irrelevant background stimuli. Now, as traders, we are inundated with irrelevant information. It is true that we actually sought out most of that irrelevant information in our mistaken belief in and search for the Holy Grail. We seem to think that more is better, and if we surround ourselves with more and more information, that by some mystical power, knowledge and wisdom will be bestowed upon us. We've subscribed to countless newsletters, sought out the best systems, take course after course, and get all the proprietary indicators for the magic systems. We may even have subscribed to an email or text alerts for all the hot trades. If I can't learn to trade, maybe I can just pay someone to tell me what to trade and when. You know how that one ends up. We get a winning trade or two and then a string of losing trades or a single trade that buries us. For some reason, we couldn't filter out the irrelevant information because we thought it was relevant. And then there is habituation. This is a process in which the brain learns to ignore repetitive, meaningless stimuli while remaining sensitive to others. The brain learns to ignore repetitive, meaningless stimuli while remaining sensitive to others? There's hope. We can learn to ignore useless information while being sensitive to useful information? Now here's the rub. We need to decide what information is useless in a given situation. How do we do that? There's the 4 stages of mastery. In any learning, there are 4 stages of mastery for a given task or subject. They are unconsciously competent, 2, consciously incompetent, 3, consciously competent, and 4, unconsciously competent. These stages are universal. There is no bypassing one to get to the next. The professionals in any given field are at the high end of level 3 to level 4. Now, the first, unconsciously incompetent, is we don't know what we don't know. In trading, this was where you were before you knew trading existed. You were in a happy state and you had a grasp on the world you knew. Babies are in this state laying in their cribs. As long as they're fed and cleaned, they're happy. Then there's consciously incompetent. Right after you learned that trading existed, you heard about the money that you could make. You then moved to this level. In any new endeavor, you see something in the future, but you don't know how to get there. You start a search to find out what you need to know to get there. It could be a book, a course, a mentor, or a series of books, courses, or mentors. You know that there is something that you need to know, yet you don't yet know how to get to your goal. Most traders are stuck here. This is the place that starts to generate all that useless information that smothers us and blocks us from the goal of making consistent money. This is the start of the search for the Holy Grail. Now, number 3 is consciously competent. Now, in any given field, when you get to this level, you can function. Maybe not well, but you can get the job done. You learn the basics and can produce a product or a service. If you're a trader at this level, you understand the markets to some degree and have winning and losing trades. You spend a good amount of time analyzing your charts. It takes you a while to make a decision to put a trade on, and you can't quite get the handle on making a consistent profit just yet, and you can't quit your job because you can't make a living just trading, even though you'd like to. Now, the 4th is unconsciously competent. This is where you want to be. When someone gets to this level, they can do the job almost in their sleep. Most physicians are at this level. But look at their training. 4 years of college, 4 years of medical school, 3 to 4 years of residency, and another year or 2 in a specialty for their fellowship. It took a doctor basically 12 to 13 years to get to this level. Do you think that a weekend course and a $50 book from Amazon or Barnes & Noble is going to get you to the same level? Now, a trader at this level can, at will, extract money from the markets on a consistent basis at a high level. This is the trader that makes an exceptional living from trading. If you were to watch a trader at this level, they would seem to react to market conditions almost without thinking. Now, they can react this way because of the repeated exposure to similar market conditions. They, either consciously through years of experience and research or through their own directed learning, have retrained their brain to ignore meaningless and useless information that other traders seem to constantly go out of their way to access. And with a laser focus, they spot the few things that let them consistently take money out of the markets. Okay, we want to make more money and by default move to the +4 area of the income chart. We may or may not want to quit our jobs at this point, but we want to make enough money to have the option of quitting our jobs. We want to get to the unconsciously competent area regarding trading. We understand that it's going to take more time and effort than a weekend course. But how much more time? We don't want it to take 13 plus years of intensive training like a physician. That's why we're watching this video series. You're right. That is why you're watching these videos. To find a way to bypass the 13 plus years of training and the $200,000 of school loans that the physician has when they finish their training. But how long will it take? If you could retrain your brain to ignore meaningless and useless information and focus only on meaningful and useful information, would that do it? Since we're inundated with tons of trash information and constant exterior stimuli like phones, commercials, junk emails, and the annoying sounds of social messages being received, being able to retrain our brains is a great first step, but is only part of what we need to do. So what do we need? We need to, 1, have a trading system that we believe will make money over time. 2, demonstrate to ourselves that it will make money over time. And 3, have the discipline to consistently and unwaveringly trade the system. We've discussed several types of trading methods and styles elsewhere in the video. So for now, we'll assume that you've identified the type of trader you are, which dictates the type of system you will use. You have the system that you will use. It is rule-based. It is a conditional system that is, if this happens, then I do this. We believe the system will make money over time. That's a nice start, but we don't put down money on our beliefs. We want proof. We need to demonstrate to ourselves that the system will make money over time. Okay, how? Trading is about charts, and you need to put in screen time. That is the time you are in front of the chart on the screen. Trading is a very visual activity. You go to your charting package and pull up the chart of the market you're going to trade. Go back a year or 2 if you have an end-of-day system, or several months if you have a day trading system. Set up your chart according to your system. Get a yellow pad and physically write down your trading rules. It doesn't matter that you already have them pre-printed. Copy them again anyway. Read them aloud after you've written them down. Doing this sounds strange and useless, but it's not. You're using your senses, and the more, the better. You've read your rules, visual. You've written your rules, physical. You've read aloud your rules, audible. This is the start of retraining your brain. Now for the rest of the brain retraining. Once you've done that, keep the yellow pad close. Pick a point on the chart, the beginning of a year or a month, and have that on the far right-hand side of the screen. Once you actually start trading, you can only trade the right-hand side of the screen. While offline in a simulated account, start trading. Apply your rules and advance the screen one bar at a time. Do you see a possible setup for an entry? What do your rules say to do? When there is a setup, apply your filtering rules. Do you take the trade or not? If yes, on your yellow pad or on the trade record log we provided, log in the trade, long or short, with the date and the price. Now advance the screen one bar at a time. Is the trade going your way? Watch your rules. How do you exit? Is there a price target, a crossover exit, a trailing stop? Did the trade not go your way? Did you get stopped out? Whatever caused you to exit, log in the exit date, the price, number of bars in the trade, the number of ticks, and the dollars won or lost. Be honest. Follow your rules for entry and exit. Most trading packages will have the ability to give you this information by drawing a line from your entry point to your exit. You can use a yellow pad or a simple spreadsheet set up like the one below. Now continue to trade. If you have an end-of-day system, trade it for at least a year. Not a year in time, a year's worth of data. That's just about 260 bars. If you have a day trade system, trade it for at least 3 months of chart data, roughly 60 bars. Doing it this way should take you about an hour or two and get a year's worth of experience. Now review your data. What were the number of winners versus losers? What were the total dollars won or lost? What was the average dollar win, the average dollar loss? What was the average number of ticks per winner or per loser? What was your average time in the trade, number of bars? Does the system as applied make money? If not, then you need to modify the system or find another one that does. If yes, then you now have proof that the system will make money in this market. This is not a feeling, a want, hope, desire, or belief. It's proof that the system can make money. But it's not proof that you can make money in the system just yet. Remember, we're doing a few things here. We're backtesting a system on a market to prove that it can make money on a specific market. We're developing confidence in our system and starting to internalize the belief that if we follow the rules, we should make money. We're retraining our brain to focus only on the information that is necessary for us to apply our rules, thereby ignoring tons of useless information and external stimuli. Okay, now that's a good start. Now do it again in a different market that you want and have the financial ability to trade. Now trading is simple, but it's not easy. You need to do this for every market you trade before you put $1 at risk. You need to put on at least 300 trades in this simulated backtesting fashion to retrain your brain to get you to the unconsciously competent level for each market by doing only one market at a time, using only one system. The first constant problem that keeps traders from making consistent money is they've never personally backtested the system they're using a strict rule set. If this doesn't happen, they never actually know if the system works. Without this basic knowledge, it is impossible to develop a consistency in your trading. The first constant problem that keeps traders from making consistent money is they've never backtested the system they're using a strict rule set. If this doesn't happen, they never actually know if the system works. Without this basic knowledge, it is impossible to develop a consistency in your trading. So they pay for a book, seminar, trading system, software, or some special proprietary indicators. They get a trade or two from them before they stop using the strict rule set that came with it, and then trash the thing saying that it doesn't work and move on to the next one. They repeat this cycle for years until they get frustrated and quit, or they've blown up their account. Some never move past this point. They spend years of frustration and thousands of dollars in the same endless loop in the pursuit of the non-existent Holy Grail. You need to prove with hard data by personally and physically backtesting the rule-based system that it really works and what to expect from it. Without first doing this, you can't believe in the system. The lagging doubt and the uncertainty of not personally proving that the system works will stop you from moving forward and making any real money. Again, trading is simple, but it's not easy. Once you have a rule-based system that you personally backtested and proved to yourself that it can make money, you then need the discipline to relentlessly and unwaveringly apply the same rule-based system in real time so you do make money. Remember, practice does not make perfect. Perfect practice makes perfect. We've just addressed the first most basic problem that traders experience. If you've come this far, the next psychological situation needs to be addressed. This too is due to prior conditioning. Earlier in this section, we talked about a cross-section of the population. Outside of the money differences in the earnings, which broke into 10 areas, we classified 8 of the 10 groupings as probable employees, and the top 1.5 sections, all of area +4 and a portion of area +3, as most likely being business owners and or professionals in their fields. Whew, that was a mouthful. Each has their own set of preconditioned responses that usually create a problem while trading. Let's first talk about the employee. They get up, go to work, and report to someone at a higher level at some time during the day or week. This person or group of people they report to directs in some way their activities. The employee takes that direction and modifies their activities to follow that direction. The employee has only to please that supervisory person or group and can leave at the end of the day with little to no concern for the success of the entity that is their employer, other than they remain in business so that the employee's job is secure. An employee has a rather structured existence with few decisions they personally make during the day. Again, this is not good or bad. It is simply how an employee acts and reacts in relationship to their employer. Now, trading, other than the actual mechanics, brings some new challenges to someone that has been conditioned as an employee. A trader has no set hours, no time card to punch, no timesheet to fill out, no expense reports, no scheduled lunch or dinner breaks. There is no one to report to. They are now totally responsible to direct their own activities. They are now in a business all their own. They need to take responsibility for the day-to-day management of that business, the daily decisions that need to be made, as well as the overall profitability. A trader's lifestyle tends to be unstructured. This can cause a great deal of distress and internal conflicts for someone that is conditioned to structure and may enjoy a structured existence. Someone that has been conditioned through their experiences as an employee may have some trouble adjusting to the new unstructured experience of trading and running their own business. You will have some new experiences as a trader. Anytime you have a new experience, there is a time adjustment to that experience and situation. It may take some time, but you will find that after a while, when you start making money, it will become easier to deal with. Let's look at the other grouping, the business owners and the professionals in their fields. This grouping has their own set of challenges when it comes to trading. As a business owner or professional in their field, these people are driven. They tend to be more aggressive. They are the movers and shakers in the community. They don't wait passively while situations around them develop. They get things done now. These are results-oriented people. They constantly want to do something. As they almost accomplish one thing, they are looking to the next thing even before the first thing is done. They plan long term. They know how to run a business and are used to making quick assessments of situations and subsequent decisions. All these things make them good at what they do. However, the same list of experiences make it harder for them to become traders. Because they're used to making decisions, they have a need for those decisions to be right. They don't like failure. Once they take a position on a market, they tend to own that position as if it defined them as a person. They have a hard time acknowledging that the market is just going the other way, taking the loss and moving on to the next trade. They can know that in their head, but because of their prior experiences and everything that has made them what they are, their gut has a hard time accepting it, and they start to ignore some of the rules. This tends to be disastrous. These people tend to take large losses because they refuse to accept the fact that the losing trades are just part of the business. You wake up in the morning, most days are sunny, some are overcast, and some it just rains or snows. That's just the way the weather is. Trading is no different. No matter what the ads say, you're not going to be trading a system that has 98% winners. If you do, you'll lose money because these systems don't take into account commissions. Other than not wanting to accept that the market sometimes moves against us, even if we do everything right, this group of people have one more major experience-based problem that they need to overcome to become successful traders. They need to learn to wait. Because they are the movers and shakers and are very used to getting things done, the faster the better, sometimes they have a problem adjusting to the markets. The markets tend to move at their own pace. As retail traders, we have no influence over the markets or their actions. As traders, we don't attempt to predict the future direction of the markets. Our job as traders is simply to react in a certain predetermined way by our trading system when we see things develop. It can be a certain chart pattern of candles or bars, a breakout of prices from a predetermined range of support and resistance areas, or a crossover of an indicator. In no way can we speed things up. We can't make them go faster. If you ever watch or talk to a trader that actually makes money on a consistent basis, you'll find that trading tends to be boring. It's not fast-paced. You're not in and out of the market every minute of the day. They wait for the right condition, see their setup, apply their filters, and then execute according to their predetermined plan. You need to develop patience and discipline. Let's talk a little bit about a few other situations you may have experienced. If you're generally under 25 to 30 years old, it may be hard to believe, but you have very limited amount of life experience compared to someone in their 60s. As in everything, this is neither good or bad. It just is. So like everything else, we deal with the situation as we find it. So what do we find? A younger person tends to have tons of energy and wants to do things. They tend to want to get some basic amount of information, not yet knowledge, and go out and do things. As a new trader, they cover the bare basics of how the markets work, the basics of a charting program, and then rush to set up an account and start looking for entry setups. Not the trading plan or the trading rules, and definitely not the money and risk management rules. They concentrate on the setups. They need to do something fast. They think all the other information is just fluff. So they put on a trade. Now, because we back-tested what we presented here, we know it works if done properly. And by luck, our new young trader had a winning trade, then another. They now know this is easy. They've had 2 winning trades, but there are no entries into the trade journal, no after-action report or assessment of their trade as to what they did right or what they did wrong. They made money. They think that's all that counts. They start to extrapolate the earnings and the know that they'll be making 100% gains per month on their money, and they start looking to get that bright, shiny new car they've been lusting over for the past year. Our new young trader didn't know that by absolute accident, they caught the beginning of an uptrend. They double up the number of contracts and put on their 3rd trade. They know how the market's going, and they're counting the profits from the moment they put the trade on. But it seems to be taking longer to make money on this 3rd trade. The market isn't moving as fast as it was before, and the trade starts to go against them. They move their stop down. They heard that sometimes those other traders are just looking to take out their stop before the market turns around, but they know that the market is going up. They'll just sit it out. Then the market moves down further. They don't want to miss the big profit, so they remove their stop. They know the market will turn around any day now. It's now 15 days into the trade. They start to look all over the internet to find some analyst somewhere who thinks the market will turn around. They start to think, this course was no good. It didn't show me anything. I'm losing all my money. They start getting up in the middle of the night to check the night session, waiting for that to turn around. Then there it is. It's starting to come back. But the next day, it's down further than it was before. It's now 23 days into the trade. The new young trader gets a call from their broker. What's this? They've never received a call, even when they set up their account. It's a margin call. The broker advises the young trader that if he wants to hold the position, he'll need to deposit more money into the account or the brokerage firm will close the position. Now he knows that he can't just take the loss, so he sends more money over to cover the margin call. Our young trader starts to get religious at this time, even though the last time he went to church was over 10 years ago. If only he had taken the small loss initially, he thinks. He hopes and prays every day with every passing bar that this will turn around. Maybe he was wrong with his initial assessment. Maybe he's starting to get the idea. A few days later, another call from the broker, a second margin call. What does he do now? He's got some money available on his credit card. Maybe he should pull some out of his IRA. He talks to his broker to discuss the situation. How could this have went so wrong so quickly? The broker, of course, has seen our young trader many times before. Our young trader has had many different names over the years and come from various cities and towns. The broker tells him just close the position down. That happens in the market sometimes, he says to our young trader. This is the only consolation he receives. He blew up his account. He lost the initial $5,000 deposit, the additional $2,000 he's had in profits, and an additional $2,000 he put in to cover the first margin call. He dejectedly goes back to work the next day, head hung low, not knowing what to say to his coworkers that he was bragging to the month before that he was going to be rich in no time from trading commodities. Our young trader is paid dearly for this education. The lessons were taught, but they may not have been learned. Okay, so what have we learned from our young trader? He bought a course. That was good. He glanced through most of it and spent most of his time, the 4.5 hours total reading, studying how to get into the market. This was bad. He had 2 winning trades. Normally, this is a good thing. But he was ill-prepared to start trading. He spent less than 5 hours learning a new skill that others spend 5 to 10 years learning. Because he has only spent less than 5 hours, there was obviously a lot missed. What he did get, he didn't apply properly. He knew the market was going up, but we don't know where the market is going. We act on probabilities, and we react to actual conditions in the market. That is, what is price actually doing? If price pattern or a combination of the two does this, then we do X. He missed the basic premise. He didn't physically backtest the system himself. Therefore, he didn't know how it worked in various conditions. He didn't have, so he couldn't follow a trading plan. A trading plan would have given him a set of rules to follow. One of the first rules after the setup and the filters is the initial stop loss. The next one of those rules would have been a time stop. He would have been out of this trade in a week. He didn't spend time on a simulator. Pilots spend hours upon hours in a simulator before ever being allowed on an actual plane. And then they only let them as a co-pilot. He didn't have a trade journal or an after-action report on each trade. How could he know what he did right or wrong and where he might improve? He opened up his initial stop loss. You never open up a stop loss. You may tighten it, bringing it closer, reducing risk, but you never move it further away and take on more risk. He met a margin call. This is the ultimate no-no. If the market has moved against you and you ever get a margin call, you obviously didn't do a number of things that you should have done. You screwed up more than once to get this far. Never pay a margin call. If you ever get to this position and need to close your positions, never pay a margin call. If you ever get to this position, you need to close your positions. Step away and do your after-action report. You need to document each step along the way that you didn't do right. You're not trying to beat yourself up, but you need to recognize what you did wrong and when. All right, what one word describes the actions and attitude of our young trader that created this disaster? Overconfidence? This one word applies to our young trader. However, it is all too easy for any trader to succumb to the problem of overconfidence. Once you're on a streak, you tend to think that you're untouchable. It's a dangerous state of mind for a trader. It generally gets to be a costly one too. Now, we've addressed what we've seen as some of the prior experiences of the employee, employer, and professional and how they may affect their trading. We just covered the situations that may affect a new young trader. There is another group of trader that we'd like to discuss. The middle-aged new trader is generally between 40 and 50 plus years of age. This person has been around the block a few times. They know enough to be cautious of exorbitant claims. They've been burned before, but not for anything too large. This person, if an employee, has generally been with the company for a while or they're a new hire. If they're a new hire, they've been through more than a few jobs. They've been working for a while and quickly realize that it's not getting them far. They're looking for something. A trading course is probably not their first attempt at getting something on the side or outside of their normal employment. This person has most likely tried Amway or some multi-level marketing. They have a healthy disbelief in new things, but keep an open mind because they're open enough to realize that it just might be the thing they're looking for. This is the person most likely to follow the directions. They will read through the entire course, maybe twice. They will do the back testing, spend the appropriate time on the simulator, and paper trade before risking real money, and do the trade journaling and the after-action reports. All in all, the middle-aged trader seems to be the least likely to have problems with performing the task involved in learning how to trade. Their biggest problem will tend to be in the money management area. They will have little to no problem trading one contract, but because they've had limited to no experience with money beyond their pay, they tend to have problems when it comes time to double up and start putting on 2 or more contracts. They can overcome this problem with continued trading when they realize that they can make money. It's okay to actually have a substantial income from trading. They are likely to continue to trade part-time for an extended period of time before deciding to leave their W-2 job. Once they start making money trading, it relieves the pressure of actually making a living on the W-2 job, and they actually start to enjoy the job and the people more. They can relax in the knowledge that they don't need the job. They do their regular job because they want to be there and have the social experience. This brings us to another group that needs to be mentioned. The senior new trader. The senior new trader tends to be 55 plus years old. They've retired or would like to be retired. They have seen quite a few things in their lives. They are concerned about their retirement, or more specifically, their money during retirement. They have or will be getting a Social Security check and a pension of some form. They've done the numbers and they believe that there just won't be enough money. They may have been forced out or bought out of their previous employment. They may be working a job at Walmart or some other job far below their experience and not utilizing their prior training or job skills. The new senior trader will act much like the middle-aged new trader, in that they will go through the course only more meticulously. Their attention to detail will be outstanding. They have enough training and experience to be able to follow directions, the ability to make a decision, and the ability to accept the results as their own. Because of their pensions and personal investments over the years, they have a better feel for money and understand the concept of risk capital. It is this same strength that becomes their weakness. They understand risk capital, but due to their personal assessment of their situation, are unwilling to risk very much of their own capital. They tend to have problems in trade management, wanting to keep their stops too tight. In an effort to protect their capital, they tend to lose it. The same money management problems that affected the prior groups affect the new senior trader as well. The solution for them is also the same. Some additional time on the simulator and continued trading will lead to confidence. Now this brings us to the last group we need to discuss. This is the experienced trader. The experienced trader has been trading for a couple of years. They originally went to a weekend seminar or bought a course. They started trading as a new trader and experienced some or all of the situations we've already discussed. They've spent both money and time on several books and additional courses. Conceptually, they can read a chart, have a discussion about the markets, and are able to discuss fundamental and technical analysis. They understand a fair bit about indicators and probably have been through several charting packages, trading gurus, and proprietary indicators. In their quest for money, or more appropriately, the ability to actually make a living from trading, they've traded several instruments. Whatever base security they've used in the past, the odds are good that they've also traded options at some point in time, because they were told by whoever was selling the course at that time that options have less risk. They have already blown out an account, generally more than once. They did it originally as a new trader and then again as a more experienced trader. They have met margin calls in the past. They probably have pulled money from IRAs, pensions, and credit cards to repeatedly fund their trading accounts. They've done what the gurus have told them. Sort of done it anyway. But they can't quite get that brass ring as they travel around the merry-go-round. They have made money in the past. They've had trades that have made them more than several $1,000s. They remember them. They'll be glad to tell you about them. They've had more than one trade that had a several $1,000 profit at one time and then watched it slowly turn into a loss before they got out. The experienced trader actually has 3 subgroups. The trader that dabbles. They go slowly. They would like to make a living trading, but need to prove it to themselves first. They have had trades off and on for several years, but their account never really seems to grow. They put on a trade once a month or so, generally stocks or options, and wait to see what happens. It's no real surprise that not much happens. The next group is someone that started as a new trader. moved to the experienced level, blew out an account, and just stayed on hold. They have had their experience of trading and it stays in the back of their mind. If they could find the right guru or system, they would start up again. They're not actively looking, but if the right book, course, seminar, or guru appeared, they'd start up again, but slowly. The experienced active trader is someone that never really quit trading. They are far beyond dabbling and keep going. They continue to trade. They put considerable time and energy into trading. At some point, they've even day traded. They have changed their trading strategy several times. They started as end-of-day trend following, moved to swing trading, and then to day trading. They've day traded trend and swing strategies and then moved to scalping, just trying to get several ticks out of a trade. But none of this has got them to where they want to be. At first look, their accounts at the end of the year seem impressive. They have a brokerage statement that shows close to $1 million or more being traded. And yet, when you look closer, with all that effort, all the books, the courses, newsletters, trade signal services, mentoring programs, and all the money that went through the account, they have a net loss of less than $2,000. But they keep coming back. They are close. They know there is a way out of where they're at with their regular job or situation. They just haven't quite gotten everything worked out yet. So what's holding them back? Why are they always just on the edge of making a living trading? Now, because they're experienced, they've had a lot of trades, they think they know what they need to know to trade. If that was really true, they'd be making a living trading, a very good living. They may have had lots of experience trading, but all they've done is reinforce a string of bad habits. Now, chances are they've never actually back-tested the system they're trading. They don't have well-defined rules. They have a close idea of a few entry setups, but they don't trade them in a consistent, disciplined manner. They have an idea about position sizing and trade and money management, but nothing is formalized, so there's no consistency. They think generally about the trades they've placed. They don't have a formalized after-action report, and they don't journal their trades. In short, they don't have the basics in place that would allow them to assess where they are. We all know that if you're lost, having a map is a great start, but it's useless unless you know where you are. The good news, if you're an experienced trader and you're listening to this video, you not only have the map, but more importantly, we have also given you the tools to find out exactly where you are. Please put your ego to the side. Use the tools and start consistently making and keeping money. Let's talk about what you need. When you come into this field, you need to be aware of your past experiences and how they might affect your trading. You need to do an honest, personal, and physical backtesting of any system you use to know the numbers. You have to be certain of the number of winning trades, the number of losing trades, and how often those trades occur. As long as the number of winning trades are more than that of the losing trades, or make considerably more money than the losing trades, you'll do fine over time. You need to retrain your brain to ignore the tons of daily irrelevant information that takes away from your trading. You need to develop consistency and discipline in following your trading rules and the patience to wait for high probability trade setups and then apply your filters. You need to exit your trades following your trade rules. You need to do your after-action reports and journal your trades to see what went right, what went wrong, and where you could improve. You also need to apply proper money management so that you can acquire long-term wealth through trading and experience your ultimate secure life at an age young enough to enjoy it. Now remember our motto: get in, get out, keep the money, then do it again and again. If you enjoyed the video or took something away from it, please like and subscribe to the channel. You'll get notified when the next video drops. See you on the next one.